Most investors will lose money in 2026, not because they are unlucky, but because they are unprepared for how the system actually works. Markets don't reward hope, hype, or confidence. They reward those who understand cause and effect. If you rely on headlines, tips, or emotions, you're already behind. But if you follow time-tested rules built on economic reality, you don't need to predict the future to win. In this video, you'll learn 5 powerful investment rules designed to help you survive downturns, capture opportunity, and stay ahead while others panic. Markets move in cycles, and understanding those cycles is the foundation of winning in 2026. Every financial system operates in repeating patterns driven by human behavior, credit expansion, productivity, and confidence. While the details change, the structure remains the same. Growth accelerates, optimism builds, leverage increases, and asset prices rise faster than fundamentals. Eventually, limits are reached. Debt becomes heavy, returns compress, and the system begins to slow. Those who understand this rhythm stop being surprised by market shifts and start preparing for them. Most investors fail because they treat each year as unique and disconnected from the past. They assume today's conditions will last forever, whether that means low interest rates, strong growth, or rising asset prices. This belief leads to poor timing and emotional decisions. Cycles do not ask for permission before they turn. They transition quietly, then suddenly. By the time the majority realizes a shift has occurred, prices have already adjusted. Understanding cycles means recognizing early signals rather than reacting to headlines. Economic cycles are largely shaped by credit. When borrowing is easy and cheap, spending increases, businesses expand, and asset prices rise. This creates a feedback loop where rising prices encourage more borrowing. Over time, debt grows faster than income, making the system fragile. Small shocks then have large effects. In contrast, when credit tightens, spending slows, risk assets fall, and fear replaces optimism. These transitions are not random, they are mechanical. Knowing where credit stands in relation to income is critical for positioning capital. In 2026, the key is not predicting exact outcomes but understanding probabilities. Late-cycle environments reward caution, balance, and selectivity. Early-cycle environments reward growth exposure and risk-taking. Mid-cycle periods favor optimization and efficiency. Investors who understand the cycle don't argue with the market. They adapt to it. They reduce exposure when risks are asymmetric and increase exposure when opportunities outweigh dangers. This flexibility creates durability over time. Market cycles are also psychological. Human nature does not change. Greed appears near tops, and fear dominates near bottoms. At peaks, risks are ignored because recent success feels permanent. At bottoms, opportunity is ignored because recent pain feels endless. Those who understand cycles learn to act opposite to the crowd. Not emotionally, but rationally. They recognize that extreme optimism often signals lower future returns, while extreme pessimism often creates long-term opportunity. Understanding cycles also helps investors avoid false narratives. Media explanations often appear logical after the fact, but they rarely explain underlying causes. Prices move first. Stories follow. By focusing on cycle dynamics instead of stories, investors stay grounded in reality. They measure conditions rather than opinions. This mindset reduces noise and increases clarity, especially during volatile periods. Cycles do not end investing success. They define it. Wealth is not built by avoiding downturns completely, but by surviving them intact and positioned. Investors who understand cycles prepare portfolios that can withstand multiple environments rather than betting everything on one outcome. They expect drawdowns, volatility, and uncertainty as normal conditions, not failures. In 2026, markets will continue doing what they have always done: rotate leadership, punish excess, and reward preparation. Those who understand where they stand in the cycle don't panic when conditions tighten or become euphoric when prices rise. They remain disciplined, patient, and aware that every phase carries both risk and opportunity. Risk control matters more than chasing high returns because investing is not a sprint for maximum gains, but a long-term process of capital preservation and steady growth. Many investors focus almost entirely on upside potential, asking how much they can make if things go right. Far fewer ask how much they could lose if things go wrong. This imbalance leads to fragile portfolios that perform well in favorable conditions and collapse when reality shifts. Losses have a greater impact on long-term outcomes than gains. A portfolio that loses 40% must gain more than 65% just to return to its starting point. Time and opportunity are lost during recovery, and emotional damage often leads to poor decisions. By controlling downside risk, investors ensure they remain in the game long enough to benefit from compounding. Survival is the first requirement of success. Risk is often misunderstood as volatility, but volatility is not the real danger. The true risk is permanent loss of capital. Short-term price fluctuations are uncomfortable but manageable. What destroys wealth is excessive leverage, concentration in a single idea, or exposure to conditions the investor does not understand. Risk control begins with recognizing what could cause irreversible damage and designing safeguards against it. Position sizing is one of the most powerful tools for managing risk. Even a good investment can become disastrous if it represents too large a portion of a portfolio. No idea is certain, no matter how convincing it appears. By limiting exposure to any single asset, investors protect themselves from being wrong. This humility creates resilience. It accepts uncertainty rather than denying it. Another key element of risk control is preparing for environments that feel unlikely. Most investors assume the future will resemble the recent past. When markets have been calm, they expect calm to continue. When returns have been strong, they expect strength to persist. History shows that the most damaging events occur when confidence is highest. Stress testing portfolios against adverse scenarios reveals weaknesses before they become fatal. Liquidity is an often overlooked form of risk management. Assets that cannot be easily sold become dangerous during periods of stress. When liquidity disappears, prices can fall far below intrinsic value, and investors are forced to sell at the worst possible time. Maintaining adequate liquidity provides flexibility. It allows investors to meet obligations, rebalance intelligently, and take advantage of opportunities created by others forced selling. Risk control also requires separating conviction from attachment. Investors can believe strongly in an idea while remaining willing to reduce or exit if conditions change. Attachment creates blindness. Conviction paired with discipline creates adaptability. Rules-based decision-making helps enforce this separation by defining actions in advance before emotions interfere. In 2026, the environment will reward those who respect risk rather than ignore it. High return opportunities will exist, but they will carry hidden dangers for those who overextend. The objective is not to avoid risk entirely, but to take risks that are understood, measured, and compensated. When risk is controlled, returns take care of themselves over time. True diversification is protection, not complexity. And many investors misunderstand this principle by confusing the number of assets they own with actual safety. Owning 10 or 20 investments does not automatically reduce risk if all of them respond the same way to economic stress. When conditions change, seemingly different assets can move together, leaving portfolios exposed at the worst possible moment. Real diversification is about balance across fundamentally different drivers, not surface-level variety. Most portfolios fail because they are built around a single economic outcome. They assume continued growth, stable inflation, or supportive monetary conditions. When that assumption breaks, everything suffers at once. True diversification begins by acknowledging uncertainty and accepting that multiple futures are possible. Instead of betting on one scenario, investors structure portfolios to perform reasonably well across many environments. This mindset shifts the goal from maximizing gains in one condition to maintaining strength through all conditions. Different assets respond differently to growth, inflation, deflation, and financial stress. Some perform well when economies expand, while others protect value when growth slows. Some benefit from rising prices, while others preserve purchasing power when inflation accelerates. True diversification intentionally combines these exposures so that weakness in one area is offset by strength in another. This creates a smoother return profile and reduces emotional pressure during volatile periods. Correlation is the key concept behind diversification. Assets that appear unrelated can become highly correlated during crises. This happens because fear drives behavior more powerfully than logic. When investors rush to reduce risk, they sell what they can, not what they should. This causes correlations to rise precisely when protection is needed most. True diversification anticipates this by including assets that are structurally different, not just stylistically different. Diversification is also about balancing time horizons. Some investments provide long-term growth but suffer short-term volatility. Others offer stability but limited upside. Combining both allows investors to stay committed through cycles. Portfolios built entirely on long-term growth often fail because investors cannot emotionally tolerate the drawdowns. Stability assets act as shock absorbers, allowing patience to survive uncertainty. Complexity is often mistaken for sophistication. Adding more assets, strategies, or products does not improve outcomes if their underlying drivers are similar. True diversification is actually simple but requires deep understanding. It focuses on cause and effect rather than labels. Investors who understand why an asset performs under certain conditions can combine fewer elements more effectively than those who chase novelty. Rebalancing is an essential part of diversification. Over time, winning assets grow larger and increase risk concentration. Without adjustment, portfolios drift back toward imbalance. Rebalancing forces investors to reduce exposure to assets that have become expensive and increase exposure to those that have become undervalued. This discipline reinforces diversification and counteracts emotional bias. In uncertain environments like 2026, diversification is not about avoiding losses entirely, but about controlling their size and duration. A well-diversified portfolio may never be the top performer in any single year, but it compounds more reliably over time. Protection is not about eliminating risk. It is about preventing risk from becoming destructive. Economic forces decide outcomes more than opinions or predictions, yet most investors act as if markets are shaped by sentiment alone. Headlines, social media trends, and expert forecasts dominate attention, but they rarely determine long-term results. Economic fundamentals, growth rates, interest rates, inflation, productivity, and debt drive market behavior. Prices adjust in response to these forces, often before anyone notices or discusses them. Understanding these mechanics gives investors an edge that opinion-based strategies cannot match. One of the most critical economic forces is credit. Easy borrowing stimulates spending, fuels business expansion, and drives asset prices higher. When credit is tight, the opposite occurs. Spending slows, liquidity dries up, and asset prices fall. These shifts are mechanical, not random. Observing how debt levels relate to income, growth, and interest rates allows investors to anticipate stress points before they become obvious in prices. Acting ahead of these cycles is far more effective than reacting to opinions after markets have moved. Interest rates are another key driver. They influence borrowing costs, corporate profitability, and consumer behavior. When rates rise, highly leveraged companies struggle, growth slows, and risk assets often decline. When rates fall, borrowing becomes cheap, spending rises, and asset prices are supported. Investors who focus on interest rate trends and their interaction with other economic variables gain insight into potential market reactions. Opinions about what the market should do matter far less than these underlying mechanics. Inflation and deflation also shape outcomes significantly. Rising prices erode purchasing power and affect corporate margins differently across sectors. Some assets, like commodities or inflation-protected securities, perform better when inflation accelerates, while fixed income instruments may suffer. Deflation strengthens purchasing power, but can compress corporate earnings and reduce investment returns. Investors who understand these forces position assets strategically to navigate various scenarios rather than relying on what commentators believe will happen. Productivity and technological progress influence long-term returns as well. Economies that innovate efficiently generate higher real growth, support stronger corporate earnings, and create wealth more sustainably. Investors who focus on industries and regions where productivity is accelerating can capture structural advantages. Conversely, ignoring stagnation or inefficiency exposes portfolios to hidden risk. Economic forces are cumulative and interlinked, and understanding their interactions is crucial for sustainable investing. Debt dynamics also deserve attention. Excessive debt relative to income or growth creates vulnerability, as small shocks can cascade into large economic disruptions. Governments, corporations, and households all contribute to overall leverage. When debt burdens are high, policy interventions may provide temporary relief, but they rarely eliminate systemic stress. Investors who measure leverage and its implications are better equipped to protect capital and identify opportunity amid instability. Relying on opinions, narratives, or predictions may provide short-term validation, but rarely produces consistent results. Experts can be right or wrong, but the market responds first to economic reality. By studying economic forces, investors base decisions on cause and effect relationships rather than anecdotal commentary. This approach reduces noise, increases clarity, and enables disciplined action even when headlines are chaotic. Economic forces also dictate risk and reward asymmetrically. Some conditions favor certain asset classes, while others penalize them. Understanding these relationships allows investors to tilt portfolios toward favorable exposures and away from systemic risk. This method is not speculation. It is preparation rooted in objective analysis rather than emotion or persuasion. Markets reward those who align with reality and punish those who chase sentiment. Decision-making rules outperform emotions over time because markets are designed to challenge human psychology. Every investor faces the same patterns: fear when prices drop, greed when prices rise, and overconfidence after success. Acting on these emotions leads to poor timing, impulsive trades, and costly mistakes. Rules remove the need to rely on instinct and provide a structured framework that guides behavior consistently, regardless of short-term market noise. Humans tend to overreact to both gains and losses. When portfolios rise quickly, optimism creates a false sense of security. Investors increase exposure, often at the peak of a cycle, only to face steep declines later. Conversely, losses trigger panic selling at the worst possible time, locking in damage that could have been temporary. Decision-making rules enforce discipline by defining actions before emotions interfere, creating consistency that emotional responses cannot match. Rules work because they translate principles into repeatable processes. For example, a rule might dictate reducing exposure when valuations exceed a certain threshold, or increasing positions when risk-adjusted opportunities appear favorable. By setting these parameters in advance, investors act according to a system, not impulses. This reduces hesitation, second-guessing, and the stress that accompanies uncertainty. Over time, consistent application of rules compounds advantages and avoids costly errors caused by emotional volatility. Another advantage of rules is that they allow objective assessment of performance. When decisions are made according to a predetermined framework, it becomes clear whether outcomes reflect the system or external randomness. This feedback helps refine strategies and improve decision quality over the long term. Emotional investing, by contrast, makes it difficult to distinguish between skill and luck, leading to repeated mistakes and misallocation of capital. Rules also help manage risk more effectively. Emotional decisions often ignore the probability of adverse outcomes or overestimate potential gains. A disciplined approach incorporates predefined limits, stop losses, or portfolio thresholds that automatically control exposure. This ensures that a single mistake or unexpected market event does not derail long-term objectives. By acting within a framework, investors maintain resilience through uncertainty and turbulence. Time horizon is another area where rules outperform emotions. Markets fluctuate constantly, and short-term noise can tempt investors to deviate from their plan. Emotions make it difficult to stay patient during drawdowns or periods of underperformance. Rules provide a roadmap specifying how to respond across various scenarios, allowing investors to maintain consistency even when immediate conditions are uncomfortable. This patience is essential for capturing compounding returns and long-term growth. Decision-making rules also encourage preparation for unlikely but possible events. Emotional reactions are strongest during surprises, yet the most damaging financial outcomes often arise from low-probability, high-impact scenarios. Rules help anticipate these situations by outlining how to adjust exposure, rebalance portfolios, or hedge risk in advance. This proactive approach prevents panic and reduces the likelihood of irreversible losses. Finally, rules support mental clarity and confidence. Investors who act emotionally often feel regret, doubt, and stress, which cloud judgment further. Rules eliminate much of this uncertainty by defining exactly when and how to act. Confidence comes not from predicting the future, but from knowing the system works over time. By following a structured process, investors can navigate volatility, capitalize on opportunity, and preserve capital more effectively than those who rely solely on instinct and sentiment.